In this video, we're going to be talking a little bit about the stock market again. We got some stock recommendations for you, and I'm going to try and answer a couple of questions that I got on my video that I did yesterday on the Iron Condors. So let's answer some questions and then look at some additional opportunities. Boeing. Now, Boeing, I want to come in here and I want to talk about Boeing just because it's been going straight sideways for so long, and Boeing is a great stock. $172 a share, and an Iron Condor on this thing would be a beautiful trade. And a lot of people ask me, Lan, why do you do these short-term Iron Condors? And so I had a conversation today with a good buddy of mine who called up, and he says, I've always thought that we're supposed to do Iron Condors with 60, 70, 80 days to go. And I'm like, yeah, you can do that. And I've done both, and I do both, and I prefer the short-term Iron Condors. And the reason I prefer the short-term Iron Condors is because the percent increase is basically the same. When you do a long-term Iron Condor, you see, oh, big dollars. Oh, look at this. I can do an Iron Condor with, 80 days to go. And oh my goodness, look at the size of these Iron Condors. And I can put those in there, and my wings can be so far away and way out here. And I can do, let's just go throw a couple of these on here, and I'll show you. There's an 80-day Iron Condor. And everybody gets all excited about long-term Iron Condors. Look at how far this is, okay? So, let's go down here, and we'll do our math. We're going to put these out at 80 and 90, just like we always do, right? So we're going to come down here. So we got to do, there we go, 80% on the out of the money probabilities, and we're going to put this one at 90. Now, a lot of guys will put these all the way out to 90. They'll put this one here at 90 and then bring this out to 95. But we can do both. So we'll come in here. We're going to bring this one out. We're going to bring this all the way out to 80, 90. We want to bring the wing out to 90. So we're going to put that out to 90. And we're going to bring this one out to 80. Okay. Now, the thing that I'm going to show you here is look how far away these are. And you're like, wow, that's great. That's awesome. Look how big my box is. Yeah, that's a big box. I mean, look how wide it is. But look how long it is. Look how long it is. This is the thing I have a trouble with. Look how long your box is. Now, the market has to stay inside that box for you to collect. How much? Yeah, a lot of money. $661. That's much bigger than these short-term condors, right? But you have to lay out $4,500. $4,500 is your margin. So you have to set aside $4,500 to make $661. Now, what's the percent increase on that? Well, that's a pretty good little percent increase. So your $4,500 investment to return $661. But the odds of that, well, they're at 80%, 80 and 90. What's the chance of this thing staying inside that box all the way to that purple line? Well, if it leaves that box anytime in that, and it's got a lot of time to do it. It can, it can go sideways for a long time, and you go 2 months and be, oh, that's beautiful. I got to only have a month and a half left, and boom, suddenly this thing takes off or falls out the floor, and you lose all your money, right? So you got a lot of risk in there, risk tolerance time frame. You say, well, go further away. Okay, well, go further away. You can go further away. We can come clear down to Corona low if we want on this thing, and we can go clear up here to Corona high if you want. You can really make a big box having a long time. And you can see over here your total premium. You're going to make about $175. You're going to lay $6,000 of your account off. And so to make that $175, you have to ask yourself, opportunity cost, is that worth it? Are you going to wait 3 months to make $175 on a $6,000 investment? Is the percent increase worth it? But the probabilities of it happening are pretty darn good. But that's why, it's all kind of a mathematical model that's designed to be exactly the same no matter what your time frame is. So that's why I do the short-term time frames. I've got very little patience. I don't like to wait this long. The thing is, you could do these and you could put one on every week. And that's what people don't understand is, I have to wait 175. I have to wait, I have to wait 3 months to make my $175. Yes, and you're outlaying $6,000. Yes, but how big's your account? What's the the increase in the amount of profits that you're going to make versus the percentage? It's all becomes the percentages are all about the same. The thing that you realize is that we're going to put one of these on every single week. So every week you're going to have $175 dropping off, but you have to realize you got to have a pretty big account to do that. $6,000 every week. So eventually, depending on the size of your account, if we got $1 million account, it's no big deal. But you're not making $175 on a $6,000 account, $6,000 investment. What's the return on investment there? So you start saying, well, I need more money than that. So then that just means you have to make your box smaller. So you have to bring your box in, and you probably want to bring your insurance policy in a little bit in case you're wrong. So it brings down your margin requirements. You notice as we bring those insurance policies in, it drops your margin requirements. Now it's so at this point you've got a $4,000 risk, so you're going to lay $4,000 out for a trade premium credit of $563. So you can make $563 on a $4,000 investment. Well, that's not bad, but it made your box smaller. So you have to take your risk into consideration, drop your box down here, and you look at it from a technical standpoint. What do you think is going to happen? Plus, you can come down here and look at the mathematical model probabilities, see what your probabilities are. And you can see on the upper side, it's an 87% probability that you're going to get your money, or actually 77%, and that's your insurance policy is at 87%. So you could bring that in a little closer, make those about equal, and then that's going to reduce your margin. So your margin's only $3,000 now for a $500 profit potential. But look at how long your box is. Your box is really long. You're like, well, I don't have to stay in it for the whole time. I can come in here. I can place this order. Let's go ahead and let's get into this market. Let's put this on there. And now what we can do is we can come in and we can say, okay, I've got my Iron Condor. I'm going to come in. I'm going to liquidate, and I'm going to say when I'm at 20%, and I don't know how long this is going to take. So you just run this up until it says, actually I'm going the wrong way, we got to run it down, until it goes in and says we're going to make 20% on our money. So let's bring it up to 20%. And we're just going to keep running this down. You can see it counting down, now minus 2%, minus 1%. Now we're at 0. Now we're going back up 6, 8, 10, and where we're going to get to 20%, and how much are we going to make at 20%? So we're at 6%, 7%, 8, and it just keeps counting up our money. 9, 10, where do you want to go? There's $50, $57, we're at 12, 13, 14, 15, 16, 18. There we go, there's 20%. And a little bit over, so we come and bring it back to 20%. There it is. 3.76 would be $95 and a 20% increase on our money. How long is that going to take? We don't know. It's just going to take as long as it takes. For the time decay, is the market going to leave this box? Are you happy with 20% or $95 on a $5,000 investment, right? So that's what we're going to do. We're going to go ahead and we're going to place that order. So now we have a limit order in there to take us off at 20% profit, and that could happen anytime. If the market just stays sideways and theta decays, we don't know how long it's going to take, right? So that's the name of the game. You could come in here and every Monday you could put one of these on. The length of the time is irrelevant because you're going to take it off at a 20% profit. Now, the problem that I've run into is I've done these on illiquid markets where the volume and open interest is very low, and I got stuck in the market and I couldn't get out. So make sure when you do these, you don't do the Land Turner trick and just do it on a market that looks great when it's got low open volume and open interest. That's why I like Boeing for this. Boeing is a much better market. It's high volume, high open interest, good market, 80 days. You got your risk versus reward ratio. You got a pretty good box here. You're going to take it off at 20%. You're not going to hold it for the entire length of time, because the length of time is irrelevant if you're just going to take it off at 20%. And since this has been such a stable market, you could put one of these on every week and just take 20% off every week, 20% off every week, 20% off every week. And it's just a savings account that continues to go on and on and on and on and on. And there you go. That's a nice little strategy for you to continually take 20% out of the market every however many days, we don't know, because it's going to be based on volatility of the market. And right now the market is not volatile at all. It's almost sideways. So it's going to take a little bit of time to give you that 20%. So that's your increase. There you go. There's your Iron Condor. And hopefully that answers the questions that I was given, why I do short-term Iron Condors versus these really long Iron Condors. It all comes out in the wash. It's all about the same. The risk is all about the same. It all comes down to time decay, and it all comes down to how much money you're going to take out of the market at a given time based on percentages and volatility of the market. Again, the mathematics of it work out to be almost exactly the same. What is different is whether the market has some sort of a fundamental move that's going to drive that market to run one direction or the other, which changes all the mathematics in the model. Okay, so you have a longer time frame within your Iron Condor, therefore you have more time for something fundamental to happen and occur that could cause you to have a loss. And that's the only difference between doing a long-term Iron Condor and a short-term Iron Condor, is you're reducing the amount of time that you have for having an opportunity for the market to have a fundamental move in the market that could throw all of your mathematics off. All right, so that's why I oftentimes will do the short-term Iron Condors and just let them run to expiration, as opposed to doing a long-term Iron Condor with a wider wing and then taking them off at 20% profit, because it all comes out in the wash. It's about the same. All right, guys, I hope that's a quick rundown on Iron Condors and give you some insight into some additional opportunities for you.